We have Danielle, DeVito-Hurley. We have Robert Mason, and we also have Jim Solomon. So we will start our first question. It'll go to Robert Mason. And Robert, can you tell us a little bit about yourself and how you developed your investment platform and why you structured your company the way you did?
Sure, absolutely. Shaun, maybe we should take a minute and just do kind of intros. We'll share a little bit about backgrounds and bios and all that, then jump into questions if that works.
Yeah, that works well.
I'll do a quick intro and then pass the mic. And then first of all, Marty, as always, thank you for putting together such a terrific event. So great to see everybody virtually. It's a little weird still to be doing this via Zoom, but it does at least make it possible, which is fantastic. Robert Mason, I'm the managing partner for Mason Capital Partners, which is basically an investment platform through which my family, we've got about a 40-year track record of investing in real estate projects. We've done about 100 deals, 110 deals, kind of through the Sun Belt of the United States, from VC down, from suburban Virginia, suburban DC and Virginia, down through Fort Lauderdale, and out as far west as Texas and Arizona. But we're really focused on Florida these days. We've created sort of an investment platform whereby our family invests, and we have kind of a team or a pool of family offices and high net worth investors that back us. We invest with a number of sponsors, a select number. Our closest relationship is Lincoln Property Company. I used to work there. And so we do an awful lot with Lincoln Property Company, particularly in Florida. We've had deals with them in Texas and Arizona as well. But we invest typically at the sponsor level. So we'll come in early, we'll take some risk, and it's a little bit like a VC pool. We'll take capital, we make smaller bets, and invest in high barrier to entry projects that we're excited about. We're asset agnostic, so we'll do all asset classes within real estate, but we invest in the sponsor portion of the capital stack typically. We've just built the headquarters for SunTrust Bank, now Truist Bank, in downtown Orlando as part of a city block we're redeveloping as the main rail stop, passenger rail stop in downtown Orlando. The first tower was SunTrust's headquarters with several other office tenants, and then 180 room AC by Marriott hotel on top. We're developing our second tower now, and then we'll have about 55,000 square feet of event space, food hall, bars, restaurants, and things that front Church Street, which is the main gathering area for downtown Orlando. We bought the headquarters for the Tampa Bay Times newspaper in St. Pete and have downsized the paper and backfilled it with other tenants. We did that deal with a hedge fund out of New York. We're talking with one of the major malls in Florida about buying a Sears parcel, Sears anchor, tearing it down and monetizing the parking lot. Basically, we'll put in sort of a city center with apartments, medical office, some restaurants, hotel, et cetera, and take advantage of the terrific location that the mall has. And then we also have several office buildings actually 7 office buildings we're buying right now in Metro Orlando, which we're very excited about for reasons we can get into. But that's kind of us in a nutshell. We're asset agnostic, very Florida centric, and super excited to see some of the, not COVID, but to see some of the results and some of the things that are happening in Florida, real estate in particular. So that's a little bit about Mason Capital Partners.
Hey, Robert, can I jump in here real quick? You're primarily I-4 corridor. Is that safe to say?
Yes, that's our favorite. That's Main Street for us. So we love Tampa, we love Orlando. So I-4 corridor is absolutely our front yard.
Excellent. Thank you, Robert. James, would you mind telling us a little bit about yourself and introducing your company?
Well, thank you. Thanks a lot, everybody. Marty, thank you so much for hosting, and glad to be part of the real estate panel. I run a single family office called Ravinia Capital Group. We actually buy in 4 parts of the country in 4 real estate food groups. So we buy office, industrial, multifamily, and retail. Office, industrial, multifamily, and retail real estate in the southeastern U.S., Texas. Matter of fact, we own something right around the corner from where you are now, Shaun, actually. Phoenix and Scottsdale because of the snowbird relationship to Chicago. And then in the Midwest, we tend to be a little bit outside of Chicago, but we're actually doing something right in downtown Chicago. I've been investing for 30 years in the real estate business. We're all private capital. We're value adding core plus type real estate investors for those on the call that are, that understand what that means. And in English, that's primarily, value add is kind of buy, fix, and sell in between economic cycles. We're trying to achieve anywhere from a 15 to 20% levered IRR on that type of real estate. And then on the core plus type of real estate, we're probably 9 to 12% IRR, but more multi-generational long-term hold. We are about 500 million of AUM. We've been in business about 6 years in this iteration. And the beauty of what we do is, we have a lot of flexibility in our capital structure. We don't have to own 100% of anything. We can own 51% of anything. And the good news is I've got a couple of partners in my business who've been doing this. One of them has been doing it just as long as I have. So for better, for worse, I've been through 3 different economic cycles, and I'm still alive and breathing. So that's a good side of it.
I agree with that. And Danielle, would you please introduce yourself, take a couple of minutes, and tell us a little bit about your firm?
Sure, of course. Well, good afternoon. Thank you all for having us. Thank you, Marty, and thank you, Milton, for the opportunity. My name is Danielle DeVito-Hurley, and I am the head of the Real Estate Transactions Group at the Gunster Law Firm. We are a full-service commercial law firm with 13 offices throughout the state of Florida. We have, by design, focused on being a Florida-only firm. We think that the business climate in Florida is the best in the nation, and we want to work with our clients to make sure that they understand all of the regulatory processes, all the way through from like dirt to CO. I've been practicing at Gunster for 26 years. I'm blessed to be surrounded by some of the best attorneys in the country here as my partners. In that time, I've handled well over $1 billion worth of real estate assets. So my goal is always to help our clients, maximize their return on investment while minimizing any potential risk that they might have, try to keep them in good hands all the way through the process. It's a pleasure being here, and I look forward to talking with you guys more.
Well, Danielle, since you had the shortest answer of them all, I'll ask you your question first.
That doesn't usually happen with attorneys.
I thought I gave her a run for her money, frankly, Shaun.
So Danielle, what are the lasting effects on real estate assets as the pandemic recedes?
So in Florida, we've been a little bit more fortunate than some other markets, especially in South Florida. And I think you've been hearing that all day long, how we're probably going to come out maybe in some of the best positions. If you look at the different asset classes, the ones that are maybe the most concerning across the country, office, retail, hotels, clearly. Industrial, I think, will always be a bright spot, at least for the near future. The office markets down here, we're feeling optimistic about, because despite the fact that the whole remote work scenario, I think, will stay in some form or another. Certainly, technology has enabled that, but we have such an influx of businesses coming into the state. I think it will absorb a lot of the vacancies that we might have otherwise had. You have Elliott Management, and Blackstone just bought 2 office buildings in Miami, and the list goes on. I'm sure you guys are as aware as I am. So I think we're not going to be as in bad shape as office as maybe some other states might be. And I think for residential, we could talk about that for hours. Our market is just exploding right now throughout the state, and that's, in past years, our markets have been driven by foreign buyers. And now I think we're 70% domestic. So a real good switch, all cash, strong buyers, multiple offers. And then with retail, obviously, I think Robert just alluded to this, regional shopping centers or malls, they're going to need a lot of work. They're going to need to be repurposed. But I think, street fronting retail is doing just fine down here. I think they're selling at a premium. So I think Florida looks like it's in really good shape to kind of come out of the pandemic and really take off.
Thank you. Thank you for that. Jim, we're going to go to you. Why is your family office primarily interested in real estate, and what are other investments are you looking at?
So the real reason is that it's kind of what we know. We've been relatively I don't know if it's lucky or smart, probably a combination of both. But we've had a lot of success in staying in the real estate space. I think the one place that we've kind of deviated is probably Proptech, property technology, because we've been owners and operators and users of real estate for so long that we've made some private equity investments, in Proptech, which has kind of kept me young and, feeling good about myself. But at the end of the day, you know, most people, so in talking about what Danielle just spoke about, look, there's a generational shift going on in real estate. For example, you've got the millennials, who are the largest population sector after the baby boomers. Baby boomers are interested in cash flow. They've been interested in, in more in income producing real estate than growth related real estate. If you look at asset allocations, you look at millennials, not to pat ourselves on the back, we made a tactical pivot a few years ago, to buy suburban office because we thought that the millennials would leave the cities, not because of their little apartment, but because they needed schools for their kids. And now the oldest millennial is 36, 37 years old. That, COVID may have accelerated that, but that trend was kind of already underway. And backfilling the cities were both baby boomers moving back who had wealth creation, sold their home in the suburbs and were moving back into the cities. But at the end of the day, real estate is a tangible asset. It's most people in the family office space have an over allocation in the alternative space in real estate because they have a second home or they own a third home and they're very comfortable in the real estate space. So for us, it's a little bit of an advantage when we're talking to people versus a venture deal or a private equity deal or a hedge fund deal, because we can all go up in an elevator and in 2 minutes and explain the transaction. And as I tell people, if somebody wants to invest with us, if I can't explain it to you in 2 minutes, you really shouldn't be investing with me because it's not that hard what we do. Okay, so that's why we stay in the real estate space. And after being as a friend of mine said, versus telling people that I'm older, I should tell people I'm wiser, which is a little pretentious. Bottom line is, after seeing all this, seeing how the world goes around, listen, we were all positioned for distressed real estate cycle coming into COVID. We all thought, oh my gosh, the world's going to be, collapsing. Florida is a great metaphor for a great real estate market that really hasn't collapsed. I have a different opinion about how people are going back into office buildings. And obviously I'm a little more positively biased, but at the end of the day, real estate was going to get repurposed. It's going to get recycled. People are going to use it for what they need for the social reasons and the professional reasons. Those are still going to exist throughout and, at the end, through COVID, the end of COVID, whatever. But at the end of the day, none of us really have the crystal ball, right? So I'd rather stick to something to answer your question in a long-winded way. I'd rather just stick to what I know and where we've been successful in, kind of making a return and try to be, an expert in something that we're capable of executing versus trying something new and screwing it up. That's why.
You got to do what you know, and your philosophy to explain something in 2 minutes doesn't only apply in real estate; it really applies to everything. All right, thank you for that, Robert. Do you want to tell us a little bit about your investment platform and how you have that structured?
Sure. So, again, we've been investing in real estate for about 40 years. So really, and I've worked outside of our family's real estate business with C.B. Richard Ellis, Hines, Lincoln Property Company, Tishman Speyer, and some others. So kind of seeing how a lot of those companies were run and thinking about how to invest our own family's capital, I just sort of looked at different alternatives, everything from REITs to, investing direct deals, which we've done a bunch of, to partnering with people and doing joint ventures. But where the philosophy that we settled on was to pool capital, to invest typically at the sponsor level, earn higher rates of return, write smaller checks, and do more deals. So that's kind of what we do. The main investment vehicle we have is a pledge pool where people opt in for, say, a 3 to 5 year period. They're entitled to their pro rata share of everything we're doing effectively. My family's been the main investor. We'll partner with groups like Lincoln, where we'll invest at the sponsor level, and then we'll have 4 or 5 different relationships, and then basically we try to pick the sponsor, and then we understand what they're doing well enough to be comfortable and kind of pick the projects that they're doing that we're comfortable doing. So it's an approach that sort of lets us spread a bucket of capital out across a number of projects and earn higher returns by investing inside the promote structure. So that's what we do in a nutshell. Some of our larger family office relationships will invest in the pledge pool, and they'll write larger checks as limited partners, and sometimes buy us out of deals as well. So that's an added feature.
Wonderful. Thank you, Robert, for that. Now, Danielle, Jim had touched on this before, how talking about, real estate will be repurposed. What are some of the biggest opportunities that you're seeing in South Florida today for real estate investments?
Yeah, I mean, I couldn't agree more with Jim that especially in South Florida where we're land constrained, we have the Atlantic Ocean on one side and the Everglades on the other, so we're not making any more land in between. I think that you're always going to repurpose what's down here. There's always going to be a demand, at least in the cycle that we're in, for a use. So I see a couple of areas that were struggling that obviously can be repurposed into something else. So you've got the regional malls that we discussed. You've got hotels, especially in urban areas. I mean, hotels are really struggling. We were at 30% occupancy, at best for a great part of the pandemic. We're coming out of that a little bit, but without business travel and foreign travel, it's going to be a long road. So I can see hotels being repurposed into multifamily, to kind of service a lot of this demand. I can see regional malls being repurposed into industrial hubs. You could, you've got the mixed family component. You've got the some more street retail. I mean, I think you're going to see a lot of opportunities by identifying the assets that did not perform during the pandemic and figuring out the better solution for them. Once you do that, I think the returns will follow.
Yeah. Okay, I'm gonna let my guys know.
I think
Guys,
talking to someone else.
I'm not gonna start till close to 5.
Danielle?
I'm sorry, Shaun, what?
Oh, I'm sorry. I think Marty is on the speaking to someone else in the background. You can
Yeah.
you can continue unless you're all done.
Gotcha. I mean, I think Jim touched on this as well. I think another area of opportunity is going to be Proptech, and we saw a really big kind of transformation or acceleration of how that's used in real estate. Whether you went to virtual showings for all different types of properties, not just residential, you had it commercial, you had it office, you have, the whole analytics of how we analyze how retail space is used. I think, investments in Proptech are going to be a really strong bet. And, especially if you have kind of like that technology bent along with the real property bent. So I think I'm a big proponent. I've lived, I think somebody in a prior panel said they were in Florida before it was cool. I've been in Florida since I was 9 months old. So, and I'm not going to disclose my age, but it was longer than 25 years. And we've obviously had recessions. We just came through the pandemic. Our regulatory climate, our tax base, our weather, I really think Florida is really positioned for some significant growth over the next couple of years.
Shaun, can I add a comment?
Yes.
Okay, so look, the COVID, the one thing COVID has created is a lot of mobility, right? I mean, for the most part, most senior people at firms have been mobile for years, so none of that's really changed. But the concept, what's happened in Southern Florida is there's been more job creation. In addition to the migration and the favorable tax environment, all the people that make corporate decisions have now looked at Florida and said, this is a great environment to run my business because my tax position as an individual or my tax position as a company is in a better place. So until there was job creation down in Southern Florida, while you had a lot of international investors, kind of buying apartments down there. And again, I'm a new resident of Southern Florida, by the way, although I'm greetings from Chicago because my home's in Chicago, but I'm now kind of migrating. People are going to go where the jobs are. So young people still need to find jobs. People need to be mentored. Middle management people need to be mentored. So there's definitely going to be a flow back to, one would say traditional office buildings. But for the most part, if there isn't jobs, they're not going anywhere. So the fact that these big companies are reloading to Florida has to do with other financial reasons. But the fact is there's more jobs in Southern Florida. That's why there's more people in Southern Florida. And that migration in effect, which is coming out of California, which now, they passed a progressive tax in Arizona, coincidentally. People coming out of Chicago in the Midwest now going to the East Coast versus going to the West Coast. And then you have all the Northeasterners kind of pouring down, whether they're temporary or permanent, we're not really sure. But there's no question there's going to be more people living in Florida over the next 5 to 10 years. So hopefully, as real estate professionals, we have recognized that, and we are, you know, preparing ourselves for that type of opportunity.
Yes, absolutely. Once a New Yorker gets down to Florida and experiences the weather, I don't think they're going to go back. maybe initially temporary will turn permanent.
Can I just jump in here for a second? You know, Jim, Solomon, just want to just, you know, they've always said that South Florida has overdevelopment, and maybe, you know, COVID has caught up with South Florida's overdevelopment. But the other side of the coin is, Alec Andronikov said earlier, you have to really experience that first South Florida summer. So,
well,
there's
I
gonna be
think
a
something, Marty, look, it has a habit of there's a chronic habit of overbuilding in Florida, right? It always occurs. There's a supply and demand cycle. Until the last, listen, it's been the longest real estate investment cycle, the last 9 years. Before, all the real estate cycles are getting shorter. So we're still kind of out there wondering what's going to happen here. There seems to be irrational exuberance in the marketplace because if you look at M2, you look at how much money the government's pumping into the economy. What are people really doing? What amazes me is that a year ago it was so friggin' hard for people to get mortgages, and now all of a sudden it's easier for people to get mortgages. I don't understand that convexity at all. However, maybe people are paying with cash because they've been saving money and they're buying homes with more down payment than they could before. I don't know. I don't have the crystal ball.
There's a macro, sure, got it. Yep.
But the point is that, you know, there is more migration. There was migration before happening because the millennials were migrating anyway. But to the Southeast U.S. or to the, you know, to Nevada or these tax-friendly states, it was already happening. But Florida has a big. I know that I bought a house in Florida 3 months ago. I took the dog out for a walk for 10 minutes. I came back in 3 hours. That was a problem the first week I was living in Florida. It was so nice. It was so great. I mean, it was difficult to focus. But
Yeah,
now
I think you and Danielle might have the same argument but I'd like to couch it differently. There's mismanaged cities, and it's easier to manage, you know, the people who you employ in Florida maybe. So there's a different plus minus on the agendas for them, you know, different positives. So
I mean, the fact that you see tech companies coming now to Miami in such numbers really does say a lot about the changing of how, you know,
where the young people are, where they want to be.
Right.
But
That,
look, you know, climate change. I mean, that's a competitive threat to real estate in Florida. I mean, it just is, and
It
we're all
is.
aware of it. But it hasn't stopped any migration at this point.
It's pretty amazing when you look at the numbers. LA, Chicago, New York, or I guess it's LA, New York, Chicago, are the three largest losers, if I can use that phrase, of population. And the three big winners are Phoenix, or the four big winners are Phoenix, Dallas, and then Orlando, Tampa, when you look at the numbers, which is kind of crazy. So Florida's got 50% of, you know, the top four cities that people are moving into. So when you look at those demographics, and South Florida's, you know, it pulled Goldman Sachs Asset Management, pulled Starwood, pulled, you know, so you see Wall Street kind of migrating south to Miami, basically, or South Florida. So the trends are amazing.
or Palm Beach, you have a lot of those same hedge funds coming into Palm Beach, not just to live here, but to bring their companies here. Elliott Management just brought, you know.
yeah, so
41
on the one hand, you know, the Wall Street has always, the wirehouses have always had operations in Tampa. Tampa's always been a big headquarters. You know, I ran a group at Chase years ago, and I was in Tampa all the time running stuff there, right? So Wall Street's always operated in Tampa. What's new is that they're coming to South Florida where their investors are, right? Because there's such a large, as Alec Andronikov said, there's such a large investor community in South Florida when you go from, you know, Jupiter Beach all the way down to, you know, the Florida Keys. So
it wasn't P.T. Barnum who said go where the money. It wasn't P.T. who said go where the money is, right? I mean,
I think that was him or a bank robber, one or the other.
Butch Cassidy.
No, but I mean, you know, there's a lot of wealth creation. It seems to be onshore. People want to be, you know, people want to be happy with their lives. It's more, you know, the live, work, play evolution really was jump started, and I think that created people more. And COVID helped create more people focused on their living environment than it did their working environment. And now that we have mobility and companies are willing to accept that to some extent, I think there's a capability to, you know, live and work remotely, and that's what's really helping, you know, drive the economic, you know, demand and frankly, in all these low tax environment states, all the areas where you see the migration going. But the migration really started a while ago. It's not new. It's just been accelerated because of COVID.
Yeah.
And we've been very successful. We haven't been able to afford Southern Florida, my company, but we've been very successful in Northern Florida. I love what Robert's doing in Orlando. I mean, Orlando, man, they get that bright line finished, and there's going to be another big impact there. But it's Orlando's seen a huge population growth.
Yeah.
And Tampa's doubled the size of their airport. Miami's a gateway city. Miami, on every institutional investor, is a gateway city these days. They look, it's not a secondary market anymore.
No, not at all.
I live in West Palm. The prices in West Palm Beach and Palm Beach have gone through the roof, crazy, beyond crazy, frankly. No, and I don't understand. I guess it's supply and demand, but it's become a hot investment market. But
yeah. So Rob, we're going to touch on you for a little bit, and I just want to know what type of trends you're seeing in the debt markets. I know we touched a little bit about on the other side, kind of some of the.
So we had put 2 office buildings under contract right before COVID, and it was very difficult to get debt financing. People were scared to death of office. We also had a food hall project in downtown Orlando that we put the kibosh on temporarily. So the debt markets definitely went on lockdown there for a little while, but they've come back. So now we see both debt funds have gotten very aggressive. They're sitting on a lot of capital, and they're lowering their rates and getting aggressive to fill the void that this rewinding 6 months ago or 9 months ago, to fill the void that traditional banks had left while they were on the sidelines. Now the banks are back, I think, for certain asset classes. Apartments and industrial didn't get hit hardly at all from a debt perspective. Development, of non-apartment or non-industrial did get hit, but that's coming back now. So I think looking forward, there's a tremendous amount of money. I've been on the phone with some bankers lately, and banks are having the problem now where they're sitting on mountains of cash that is earning 0.1% per year otherwise. So they are eager to lend, I think. We don't have the massive amounts of development that we might normally coming toward the end of a real estate cycle. So I think we're a little healthier, depending on where you are. But we've been saying on this panel how strong Florida is. So many people moving in. Texas, Florida, Arizona, I think, are 3 of the huge winners.
yeah.
So if you get a good quality project, there's debt now is the summary, and pretty aggressive debt is coming back. So, I don't know that people are going to go crazy with leverage. There's a lot of equity out there too. And I guess the one thing I'll say very quickly, while we love real estate, it's a great hedge against inflation. We're looking to buy, 7 office buildings right now. We'll put long-term debt on it, lock it in. And as rents roll, the rent rolls were 97% leased in all those buildings, but we're 20+% below market. And then there are all these tenants moving in. Market rates are going to spike. We're not even near replacement. We're not even near the point where new construction is justified based on rental rates. So we'll get another 20% pop on top of where we are, we think, before there's new supply. So it's a phenomenal time to buy, lock in your debt, and hold, in our opinion.
Very, I agree with that. Jim, I'm going to stay on the topic and then throw this to you. You might be a longer term investor, but what are some of your thoughts on being having some short-term investments and long-term opportunities? What are you seeing?
Everybody in America wants to own industrial properties and multifamily properties. So clearly the cap rate compression has been severe in every single property market that you want to own real estate in. So if you can find an opportunity, you should jump on it. I'm going to what Robert said about debt markets. There's 2 different or 3 different types of institutional financings, and I just wanted to comment. I'm going to switch back to your question. But the debt funds have always been there. They're just higher cost than the traditional lenders, like life companies and banks. Banks have come back into the market, in particular for office, but on long-term lease deals like the ones Robert's buying, they're kind of been there and they're happy, but they were not there on short-term traditional real estate. So retail, hotel, office, no financings other than debt funds or maybe CMBS, And then on industrial and apartment, that whole business has never gone away. Every bank in the world will throw themselves at a industrial deal or a multifamily deal. Back to what you said, short-term opportunities, we're seeing it. We do, we've been a buyer of suburban office. We bid on something recently in Atlanta. We get outbid. It was okay, but surprised that somebody was, that number one, there was a seller into that market, and also that there were buyers. People kind of realized that below replacement costs, that reasonable cost bases, there's still transactions to be done. There is debt liquidity out there, which drives all real estate transactions. So short-term for us, I think we are working on a very interesting apartment deal in Chicago in the Gold Coast, which is Park Avenue, Chicago. We're going to buy because we wouldn't have the opportunity if it wasn't for COVID. We're doing an opportunity zone investment because we mine some capital gains. We're building workforce housing in Washington, D.C. on our second phase. We're through that, but that's not really, that's more of an exceptional business. And then other opportunities we see in the middle market space where we're in, which is a $10 to $75 million size deal. We see different pockets of opportunities, but as an investor, either long-term credit leases for retail or for office, I think that's kind of an opportunity if you can get the right cap rate execution. Again, we talked about apartments and industrial. Hospitality, I'm not smart enough. We're not hospitality investors. And I think in specialized real estate like self-storage, you're seeing a lot of development still occur. You're seeing self-storage, you're seeing, life sciences seem to be the rage. Although those, the cost of building those buildings is huge. You better have a good lease before you undertake that development project. I don't know how much spec that's going in. Long-term opportunities, we're not going to deviate that dramatically from our business plan because I like the fact what we tend to do is go into a market and go through all the brain damage and like to pivot to different risk reward type opportunities within that market. Again, that's our strategy. Other people that are more specialized, but long-term, it sounds like, industrial's here to stay. Multifamily, we can't build enough housing. We certainly don't have enough affordable housing in the marketplace. There's articles all over the paper today and yesterday and the day before about the shortages in these urban markets. Interesting what California did, by the way, where they bought up some of these hotels and immediately turned them into affordable housing. I thought that was fascinating. South Florida may have an affordable housing issue. I don't really know. Long-term, I don't know. I think that, rising tide help all boats. I don't want to make this too long. I don't really have a longer than a year or two strategy right now because the world's still kind of changing. Get through COVID, I'll have a different opinion.
Well, that's a smart way to look at it for sure.
You got about 2 minutes, Shaun.
Go ahead.
Just 2 minutes.
Oh, 2 minutes. We could just put it to Danielle for a quick little answer for this. And I just wanted to ask her, why do you think South Florida makes a great place to invest as opposed to anywhere else in the country?
I could put on my Chamber of Commerce hat. South Florida, the fundamentals in South Florida are just, I'd put them up probably against almost any other region, maybe like you said, Texas and Arizona. So Florida, it just in general is the third most populous state in the country. I think we passed New York a while ago. Florida's consumer market is the fourth largest GDP in America. If you had Florida as a separate country, we'd be the sixth largest economy in the world behind Mexico. All of the things that we've talked about before. So, when the Tax Reform Act repealed the SALT exemption, you had this kind of exodus into Florida that COVID is just really accelerated, right? So you come here, there's no income tax, there's a great workforce, we're a right to work state. We have skilled labor. We probably do have an issue with affordable housing, clearly. We have an issue, a soft spot in our economy on hospitality, no doubt. I'm doing a deal right now, which is a public-private partnership with the city of Pompano for a hotel. And my client doesn't expect we're going to get, anybody lined up for at least 18 months. Hospitality is really the one area that I'm probably the most concerned about. And my hotel clients are, really struggling. We're the gateway to Latin America. We've talked about that before. I think the most promising part of our economy is the investment coming not necessarily from Latin America, like we talked about before, or Asia or Russia, as it historically has been, but really domestic investment in cash, and true migration. I think Jim touched on this probably before. true people coming for jobs, not just, you know, moving here because they want a retirement home or they want to spend a couple of months a year. So I think all of our markets, with the exception of hospitality, which I'm a little less optimistic about, I think all of our markets are going to do very well, at least, you know, for the remainder of this cycle. How long that is, obviously, that's anyone's guess, and we all need that crystal ball to really time it perfectly.
Yeah, so great job, guys. I think it's really fascinating. And, you know, my perspective is that, and maybe getting what Jim Solomon was talking about, is that people are making like very strong decisions. So you see this booming car market that's happening right now where people are buying, you know, luxury cars out of control. And, you know, so people are just, they're making decisions. I want a nice car. I want to live in a nice place. They move to Florida. I want to get away from the confusion and chaos that I'm living in now, et cetera. And personally, you know, with regards to Robert Mace, I love the I-4 corridor. It's a fantastic university population there with University of South Florida,
UCF,
Florida, Central Florida, et cetera. So there's so many great universities graduating. Most of the engineers in the state of Florida come from that area. So, so if you're like a venture capitalist looking to invest, that's probably one of the better areas to look. So
there are 500,000 college students in a 100-mile radius of Orlando.
right, that's incredibly impressive, right? Right.
All of them are looking to become Mickey Mouse.
What's that? Sorry.
I said all of them are looking to become Mickey Mouse.
Yeah.
and those are, you know, historically, I grew up in Florida, and all the top universities were always in Central Florida from the beginning for me. So, fantastic way to go, guys. Thanks so much. Great job.